I have pulled somewhat of a comprehensive problem out of your text to provide an illustration of the operating budget. So we're going to look at the examples we covered within the chapter: the sales budget, production budget, material, labor, overhead, cost of goods sold, selling and general administrative expenses. Let's take a look at these utilizing the company Huber Batting Company. So Huber's manufacturing baseball bats, and in this case we have two products, which is a little more complex than what we saw originally with one product, but I think it's a good illustration for us to review. So we're selling bats to sporting goods stores. All of our sales are on account, so we have accounts receivable. We sell the youth bat for $35 and the adult baseball bat for $65. So it tells us that our highest volume takes place in the first 3 months of the year. So we're going to be looking at a budget for the first quarter. So they've provided us with Huber's balance sheet for the last quarter of 2016, and they've asked us to put together a budget for the first quarter of the following year in 2017. So the additional information that they've provided gives us the amount of budgeted sales for both types of bats, the finished goods inventory that currently exists of youth bats and adult bats. They provided us with the desired ending finished goods inventory. This is for the end of the first quarter that we are about to budget for. We have direct materials cost. We have raw materials inventory cost, direct labor at half an hour per bat with $15 per hour wages. We have variable and fixed manufacturing overhead. We have variable and fixed selling and administrative expenses. Okay, so using this information, we're going to prepare all of the budgets required for the operations budget. Okay, so let's start with the sales. And first of all, the book has projected that we would sell 1,300 youth bats, 3,100 adult bats. It's pretty simple. The number of bats we predict we can sell times the sales price per bat, and we have our total sales. Okay, so at this point, this was fairly easy. Okay, and as easy as the calculations seem, I have net income. I have sales for my income statement at this point. It's a very simple calculation. But once again, this is the cornerstone of our budget. Our budget is only as good as this budget of the bats that we have predicted that we can sell. If this is off, the rest of our budget will also be off. Okay, because using the number of bats that we think we can sell, you can see the 1,300 moving down to the production budget, 3,100 moving down to the production budget. We're not always going to produce the same number that we can sell. We know the number of bats that we can sell. We know that the text said we wanted to leave some in ending inventory. So I need the 1,400 and 3,650 bats is the total that I'm going to sell plus what I want to leave in ending inventory. We know from the information above that we already had some bats in beginning inventory, so we've subtracted those. So once again, okay, let's take a look back. Let me get the cursor back. The number of bats that we know that we can sell, plus the number of bats that we want to leave in ending inventory, less the number of bats that we already have when we begin this period, and that gives us the number of bats that we need to produce. Okay, this is all hinging on the number of bats that we can sell. And now the number of bats that we are going to produce is going to determine our cost for materials, for labor, and for overhead. Okay, so let's go back up and take a look at this. The book gives us the information. It tells us that the direct materials per bat are $7 and $9 for the youth and adult bats respectively. So we can calculate the number, the dollar amount of materials that we need for production. $5,250, $28,890. So if I know the number of bats that I need, if I know the materials for the bats that I need to produce, I'm going to add to that any materials that I already had in, that I want to leave, in ending inventory. Okay, so the materials that we need for production plus the materials that we want to leave in our raw materials ending inventory, and I'm going to subtract from that any materials that I had when I started. Okay, so as I mentioned to you guys, this formula is going to follow us throughout the semester. how much do we need to produce, plus what we want to leave in ending inventory, less what we already have, tells us what we need to produce. Raw materials. How much do I need for my product? How much do I want to leave in ending inventory, less what I already have? Okay, so these are not complex, but we have to understand the formula to understand the amount that we need to produce and the amount of materials that we need in that production phase. All right, let's look at labor. This one's not quite as complicated. We know the number of bats, not that will be sold, but that will be produced. Okay, so the number that we will produce from our production budget above times the number of hours that are required per bat, okay, gives me the number of hours that are going to go into production at my average rate of $15 an hour. Now I have the cost of labor. Okay, so slowly but surely we're beginning to calculate. We've got labor cost, I have budgeted direct materials cost, and now I need my manufacturing overhead to know the cost of the inventory that I am going to produce in this particular quarter. Manufacturing overhead is allocated based on the number of bats that we're going to produce, once again from my production budget. And your text told us that the variable overhead costs per bat were 50 cents per bat. It told us that the depreciation and insurance and property taxes were fixed costs. They would remain the same quarter after quarter. So we can calculate our budgeted variable overhead, and then we can calculate our budgeted fixed overhead in order to calculate our total manufacturing overhead cost. Okay, so now we have the three costs of production: materials, labor, and overhead. Does anyone remember the next budget that we prepare? These are our product costs that we're going to need. What happens when I sell this inventory? It's going to move off of the balance sheet and it's going to the income statement via cost of goods sold. Okay, so this is a little more complex than what you saw in your chapter, but I wanted you to see an illustration with more than one product, and I wanted you to see an illustration that actually uses the FIFO method of inventory in calculating a budgeted cost of goods sold. Okay, so bear with me here. Pay attention as we move through. We're going to calculate two different costs for our cost of goods sold budget. First, we're going to calculate the cost of the bats that were already in beginning inventory. These were finished. These already had a cost. Okay, those 650 bats were cost us $17. The adults cost $14, and so that gives us our beginning inventory that we started with at the beginning of the semester or the beginning of the quarter is here. So when I sell bats in the next quarter, they're going to come from this batch first. So the first youth bats that I sell will move out at $17 a bat. The first adult bats will move out at $14 per bat. All right, but we're going to sell all of them in the first quarter, so we really just need the total. Okay, so what I need to go along with what was in beginning inventory, I also need to know the cost of the bats that were both, notice here, produced and sold. Okay, because if they weren't sold, these costs do not move over to cost of goods sold. They stay on the balance sheet as finished goods. Okay, so what I need to know, I know the cost of the bats that I had in beginning inventory. I need to know the cost of what I produced and sold in the first quarter, or what I predict to produce and sell in the first quarter. We've predicted 1,300 youth, 3,100 adult. And so if we know we're going to sell 1,300, I have 650 already. I'm going to need to produce the other 650, produce and sell. If I had predicted sales of 3,100 adult bats, 440 of those are coming from up here in my beginning inventory, then I'm going to sell 2,660 of the bats that I produced in the first quarter. So I need the cost of these 650 and these 2,660. And if I go back to the materials that we calculated, the labor that we calculated, the manufacturing overhead that we calculated, then we can take our total cost divided by the total number of units that we produced to come up with our cost per youth bats, adult bats, the labor, okay, for each, the manufacturing overhead for each. So I've calculated a per unit cost for the bats that I both produced and sold in the first quarter. So using these numbers, you can see the $18.50 pulls here. You can see the $20.50 pulls here. So the 650 youth bats that I sold moved at a cost of $18.50 a bat. The 2,660 bats that I produced and sold in the first quarter moved at $20.50 a bat. So these are the cost of the units that I produced and sold in the first quarter. These are the cost of the bats that I already had. I sold each set of them. Okay, so if we simply pull that together, let me give you enough screen that you can see both. From the beginning inventory, the first sales, first in, first out, means the first items that I sell, the costs are going to come out of beginning inventory. The $11,050 for youth, the $6,160 for adults, for $17,210. Then I need the cost of the bats that were produced and sold. The $12,025 pulls here, the $5,430 pulls here, and I can calculate the total cost of back up here. I can calculate the total cost of youth bats sold, the total cost of adult bats sold, the total cost that needs to move into cost of goods sold on my income statement for the budgeted income statement. Okay? So we have sales. If we back up, we have sales, we have production. Once we know production, we can calculate the materials and the labor and the overhead. Once I know the complete cost of material, labor, and overhead, I can calculate a per unit cost to determine the per unit cost that needs to be applied when I sell my inventory, and that is the dollar amount that I'm going to use to move items out of the balance sheet over to cost of goods sold on the income statement when these items are actually sold. Okay? So now we have a selling and administrative expense budget. Once again, the period related expenses. The book pretty much gave us all of these as fixed costs: salaries, rent, insurance, depreciation, and our supplies expense were predicted to be 3% of sales, so fairly easy. So now I have the cost of goods sold for my income statement, I have selling and administrative expenses for my income statement, and I have sales. All right, there are a couple of other things that we need to consider, but we're beginning to fill in the skeleton. Okay? So once again, each of these budgets are a part of the supporting documents that we need to prepare an operating budget for an organization. And this operating budget is just one part of the puzzle that we are going to use to calculate the overall master budget. Okay, so take a break, make some notes if you would like, and we're going to take a look at one other example to help us look through cash receipts.